In 2019, Spirit Airlines looked unstoppable. Its bright yellow planes were everywhere, advertising unbelievably cheap fares, sometimes as low as $29. Passengers often complained about paying extra for everything from carry-on bags to a bottle of water. But despite the criticism, people kept booking flights. Spirit had figured out something powerful. Millions of travelers were willing to sacrifice comfort for the lowest possible price. For years, that strategy worked brilliantly. Spirit became one of the most profitable airlines in the United States, and its stock price reached record highs. Investors loved the business model, and the airline was seen as a disruptive force, shaking up the entire aviation industry. Fast forward just a few years, and the picture looks completely different. Spirit Airlines has filed for bankruptcy and is now fighting for survival. Its stock has collapsed, merger plans have failed, and the company is buried under billions of dollars in debt. What went wrong? How did an airline that once dominated the ultra-low-cost market fall into such a severe crisis in less than a decade? To understand that, we need to go back to the beginning, the early years. Spirit Airlines didn't always look like the budget airline we know today. The company actually started in 1983 under a different name, Charter One. At the time, it wasn't even a traditional airline. Instead, it operated as a charter company based in Detroit, organizing vacation packages and tour flights. Nearly a decade later, in 1992, the company rebranded itself as Spirit Airlines and began offering scheduled passenger flights. Throughout the 1990s and early 2000s, Spirit operated much like a typical low-cost airline. It offered cheaper tickets than traditional carriers, but it still included many of the services passengers expected, things like complimentary drinks and snacks. But the real transformation came in 2006. That year, Spirit made a bold strategic shift under CEO Ben Baldanza. Instead of competing as just another low-cost airline, Spirit decided to fully embrace a new concept that had already been successful in Europe: the ultra-low-cost carrier model, the radical strategy. The idea behind the ultra-low-cost model was simple but controversial. Strip the airline experience down to its absolute basics. Instead of including services in the ticket price, charge passengers separately for everything beyond the seat itself. Want a carry-on bag? That's an extra fee. Want to choose your seat? Another fee. Need to print your boarding pass at the airport? Yes, even that could cost money. Spirit removed almost every free service that traditional airlines provided. No complimentary snacks, no free drinks, and not even free water on board. At first, many industry experts believed this strategy would fail in the United States. But Baldanza understood something important about consumer behavior. A huge number of travelers, especially vacation travelers, only care about one thing: the cheapest ticket possible. If an airline could offer dramatically lower base fares, many people would accept the extra fees. Spirit leaned into that idea completely, building the ultra-low-cost machine. By 2010, Spirit had fully transformed into America's first true ultra-low-cost airline. And the results were remarkable. Between 2011 and 2015, the company's revenue more than doubled, from around $1 billion to over $2 billion. Even more impressive were its profit margins, which quickly became some of the highest in the airline industry. At one point, Spirit's operating margin reached nearly 24%, significantly higher than major legacy carriers like American Airlines or United. The airline's success was built on three key strategies. First, Spirit maximized the number of passengers on each plane. The airline squeezed far more seats into its aircraft than traditional airlines did. By reducing legroom and eliminating reclining seats, Spirit could fit roughly 30% more passengers onto the same plane. For example, a typical Airbus A320 at Spirit carried around 182 seats, while other airlines usually installed closer to 150 to 160. More passengers per flight meant that fixed costs, like fuel, pilots, and airport fees, could be spread across more tickets. Second, Spirit relied heavily on ancillary revenue, which simply means extra fees. While most airlines earned a small portion of their revenue from add-ons like baggage fees, Spirit took this idea much further. Nearly half of the airline's total revenue eventually came from these additional charges. In fact, The average passenger often paid more in extra fees than they did for the base ticket itself. This allowed Spirit to advertise extremely low fares that grabbed attention while generating profit through optional upgrades. Finally, the airline kept its operations extremely simple. Spirit operated a relatively young fleet consisting mostly of Airbus A320 family aircraft. Using similar planes reduced maintenance costs and made pilot training easier. The airline also avoided complicated hub and spoke networks. Instead, it focused on direct point-to-point routes, especially between popular leisure destinations like Orlando, Las Vegas, and Caribbean vacation spots. The strategy was efficient, aggressive, and incredibly disruptive. And it was about to change the entire airline industry. As Spirit Airlines expanded across the United States, its influence on the airline industry became impossible to ignore. Whenever Spirit entered a new route, something interesting happened. Ticket prices across all airlines suddenly dropped. Economists eventually gave this phenomenon a name: the Spirit effect. A study conducted in 2016 revealed that when Spirit launched service in a market, the average airfare on that route fell by around 17%. Even passengers who never flew Spirit benefited from its presence because larger airlines were forced to lower their prices in order to compete. In many ways, Spirit democratized air travel. Millions of travelers who previously couldn't afford to fly suddenly had access to incredibly cheap tickets. Weekend trips, short vacations, and spontaneous travel became possible for a whole new group of customers. From a business perspective, the airline looked like a success story. But behind the scenes, problems were slowly building. The customer experience problem. Spirit may have been cheap, but it certainly wasn't loved. The airline consistently ranked near the bottom of customer satisfaction surveys in the United States. Complaints about cramped seating, unexpected fees, and poor service were common. Many passengers felt frustrated when the advertised fare didn't reflect the final cost of their trip. A $29 ticket could quickly turn into $100 or more once baggage fees, seat selection, and other charges were added. The frustration showed up clearly in government data. In 2015, the U.S. Department of Transportation reported that Spirit had the highest complaint rate of any major airline in the country. The airline received nearly 3 times more complaints per passenger than its closest competitor. And Spirit's leadership didn't exactly try to hide from the criticism. CEO Ben Baldanza became famous, or infamous, for his blunt responses to unhappy customers. In one widely shared incident, a passenger emailed the airline complaining about a delayed flight. Baldanza accidentally hit reply all and responded with a message that quickly went viral. His response essentially said that the airline didn't owe the passenger anything, and that if he didn't like the service, he was free to fly with someone else. To many observers, that email perfectly captured Spirit's philosophy. The airline wasn't trying to offer luxury or comfort. Its entire mission was simple: provide the lowest possible fare. If passengers wanted a more comfortable experience, they could choose another airline and pay more. For years, that approach worked. But then the world changed. The pandemic shock. When the COVID-19 pandemic struck in early 2020, the entire airline industry entered the worst crisis in its history. Flights were canceled worldwide, borders closed, travel demand collapsed almost overnight. Every airline suffered. But Spirit's business model made it especially vulnerable. Unlike major airlines such as Delta or United, Spirit didn't have multiple revenue streams to rely on. Traditional carriers could offset some of their losses through cargo operations, international travel, and business class passengers. Spirit didn't have those advantages. Its customers were primarily price-sensitive leisure travelers, people flying to vacation destinations like Las Vegas, Orlando, or Caribbean resorts. And those travelers disappeared almost instantly when lockdowns began. Tourism stopped. Vacations were canceled. Airports became nearly empty. Spirit suddenly found itself with dozens of grounded planes and almost no passengers. The airline's capacity dropped by more than 80% during the second quarter of 2020. In just 3 months, the company lost over $140 million. By the end of the year, Spirit had accumulated more than $500 million in losses, changing passenger priorities. The financial losses were severe, but the pandemic created another challenge that would haunt Spirit long after travel resumed. Passenger expectations began to change. Before the pandemic, many travelers were focused mainly on price, but after COVID, people started prioritizing different things when booking flights. Flexibility became extremely important. Travelers wanted the ability to cancel or change their flights without heavy penalties. Cleanliness also became a major concern. Airlines began highlighting sanitation procedures and cabin air filtration systems. And perhaps most importantly, passengers began caring more about space and comfort. Unfortunately for Spirit, those were areas where the airline had always struggled. At the same time, traditional airlines began adapting. Major carriers eliminated change fees for many tickets and improved their own basic economy options. These cheaper fare categories allowed legacy airlines to compete more directly with Spirit's prices. As a result, the price gap between Spirit and its competitors began shrinking. The airline's biggest advantage, ultra-cheap tickets, was slowly disappearing. The 2021 operational meltdown. Just as travel demand started recovering in 2021, Spirit faced yet another crisis. During the pandemic, the airline had furloughed or laid off thousands of employees to reduce costs. But when travel demand rebounded faster than expected, Spirit struggled to rebuild its workforce quickly enough. The result was a massive operational breakdown. In August 2021, Spirit canceled more than 2,800 flights within just 10 days. Tens of thousands of passengers were stranded across the country. Airports filled with frustrated travelers waiting for hours or even days to reach their destinations. The chaos cost the airline an estimated $50 million, but the damage to its reputation may have been even worse. For an airline already known for customer dissatisfaction, the meltdown reinforced the perception that Spirit was unreliable. And while the airline eventually stabilized operations, the crisis exposed a major weakness in its ultra-lean business model. Spirit had designed its operations to run with minimal margins for error. When everything worked perfectly, the system was efficient. But when disruptions occurred, the airline had very little flexibility to recover. By the beginning of 2022, it had become clear that Spirit Airlines needed a major change. And that change seemed likely to come in the form of a merger. By early 2022, Spirit Airlines was under increasing pressure. The pandemic had damaged its finances, operational problems had hurt its reputation, and competition from larger airlines was becoming more intense. Spirit's leadership knew the company needed something big to stabilize its future. The solution seemed obvious: merge with another airline. In February 2022, Spirit announced a major deal with Frontier Airlines. The two companies revealed plans for a merger valued at roughly $2.9 billion. On paper, the partnership made perfect sense. Both airlines operated very similar business models as ultra-low-cost carriers. They also used the same type of aircraft, the Airbus A320 family, which meant their fleets were already compatible. If the merger succeeded, the combined airline would become the fifth largest carrier in the United States, controlling about 8% of the domestic market. Even more importantly, the new company would become the largest ultra-low-cost airline in the country, giving it enough scale to compete with the four dominant airlines: American, Delta, United, and Southwest. For Spirit, the Frontier merger looked like a logical path forward. But just 2 months later, everything changed. A surprise bid. In April 2022, another airline entered the picture, and it shocked the entire industry. JetBlue Airways suddenly launched an unexpected takeover bid for Spirit. Their offer was worth about $3.6 billion, significantly higher than Frontier's proposal. In fact, it represented a 37% premium over the Frontier deal. For Spirit shareholders, the math was simple. JetBlue was offering more money. But Spirit's leadership wasn't convinced the deal would actually succeed. The reason was regulation. JetBlue had already formed a partnership with American Airlines known as the Northeast Alliance, which had attracted scrutiny from U.S. antitrust regulators. Spirit executives believed that regulators might block a JetBlue acquisition because it could reduce competition and raise ticket prices. Because of that risk, Spirit's board initially rejected JetBlue's offer, even though it was worth more. Instead, they continued supporting the Frontier merger. The bidding war? JetBlue wasn't willing to give up. Instead of negotiating quietly, the airline decided to go directly to Spirit's shareholders. What followed became one of the most intense bidding wars in modern airline history. JetBlue repeatedly increased its offer, raising the purchase price again and again in an attempt to win shareholder support. Eventually, the offer reached $3.8 billion, representing a massive 57% premium compared to Frontier's final proposal. At that point, many investors began to question whether rejecting JetBlue's offer made sense. Spirit's leadership still worried about regulatory approval, but shareholders were increasingly focused on the higher payout. After months of uncertainty and negotiations, the decision finally arrived in July 2022. Spirit shareholders voted against the Frontier merger. With that deal rejected, Spirit's board had little choice but to accept JetBlue's offer. The acquisition agreement was signed, and it looked like Spirit Airlines would soon disappear as an independent carrier. But the story wasn't over yet. The government steps in. Soon after the deal was announced, the U.S. Department of Justice launched a legal challenge. Regulators argued that allowing JetBlue to acquire Spirit would reduce competition in the airline industry. Spirit had been responsible for lowering ticket prices in many markets. If the airline disappeared, regulators feared fares could rise for millions of travelers. The Justice Department formally filed a lawsuit to block the merger. What followed was a long and closely watched court battle. Both airlines argued that the merger would actually benefit consumers by creating a stronger competitor to the largest airlines. But regulators disagreed. They claimed that Spirit's ultra-low-cost model played an important role in keeping ticket prices low across the industry. If JetBlue absorbed Spirit and converted its planes into a more traditional configuration, that low-cost pressure would disappear. After months of legal arguments, the decision finally came in January 2024. A federal judge ruled against the merger, effectively blocking the deal. The collapse. The court ruling was devastating for Spirit Airlines. The company had spent nearly 2 years pursuing the merger instead of focusing on rebuilding its own business. Now the deal was dead. Almost immediately, Spirit's stock price collapsed. Investors who had hoped to receive the premium payout from JetBlue suddenly saw those expectations vanish. The airline was left with no merger partner, growing financial problems, and very limited options. In a final attempt to salvage something from the situation, Spirit and JetBlue tried to form a smaller partnership in early 2024. But even that arrangement fell apart within just a few months. Spirit was once again on its own. Its stock price hovered around $3 per share, a dramatic fall from its earlier highs. And the airline now faced a harsh reality. Without a partner, without new investment, and with rising debt obligations, Spirit Airlines was running out of time. After the collapse of the JetBlue merger, Spirit Airlines found itself in one of the most difficult positions in its history. The company was suddenly alone again. Years of uncertainty had weakened the airline financially. Its stock price had crashed, debt levels were rising, and investors were losing confidence. Spirit now had to survive without the merger that many believed would save the company. And that meant making some extremely tough decisions. Desperate cost-cutting. Throughout 2023 and early 2024, Spirit began implementing aggressive cost-cutting measures to stabilize its finances. One of the first major steps was reducing future aircraft deliveries. Airlines usually place aircraft orders years in advance. Spirit had previously planned to expand its fleet significantly, expecting strong travel demand in the future. But the reality had changed. Instead of growth, the company needed to conserve cash. Spirit announced it would delay multiple aircraft deliveries scheduled for 2025 and 2026. While the airline had to pay penalties for postponing these orders, the move helped preserve short-term cash. The company also decided to shrink its existing fleet. Plans were announced to retire around 26 aircraft, representing roughly 13% of Spirit's planes. At the same time, the airline began cutting routes, particularly in smaller markets where competition from larger airlines was strongest. These changes were expected to save the company between $80 million and $100 million per year. But the savings came with a cost. Fewer aircraft meant fewer flights, which also meant fewer passengers and less revenue. Selling assets to stay alive. Spirit also explored financial strategies commonly used by struggling airlines. One of these strategies is called a sale-leaseback. In simple terms, the airline sells some of its aircraft or engines to leasing companies in exchange for immediate cash. Then it rents those same planes back and continues using them. This approach can provide a quick injection of money when a company is facing financial pressure. However, it usually becomes more expensive in the long run because the airline must pay ongoing leasing costs. Still, for Spirit, survival in the short term was the priority. The company also began cutting costs in other areas, including reducing its workforce and restructuring internal operations. These measures helped temporarily slow the financial bleeding. But they couldn't fix the deeper problems. Moving away from the original model. Perhaps the most surprising change came in May 2024. Spirit announced a new product called Spirit Plus. For the first time, the airline began offering premium-style seating options that included extra legroom, free drinks, and priority boarding. In other words, Spirit was introducing features that were completely opposite of the ultra-low-cost model it had built its reputation on. For years, Spirit's strategy had been simple: offer the cheapest possible base fare and charge for everything else. Now the airline was experimenting with offering better comfort and services. Industry analysts saw this as a sign that the original business model might no longer be working. The ultra-low-cost formula that once made Spirit so successful was now struggling to compete against larger airlines that had adopted similar pricing strategies. The debt problem. Despite all the cost-cutting efforts, Spirit still faced a major financial obstacle: debt. By 2024, the airline had accumulated roughly $3.9 billion in debt and lease obligations. At the same time, its cash reserves were shrinking rapidly. With such heavy financial pressure, Spirit's flexibility was extremely limited. The company warned investors that it might not be able to meet its upcoming debt payments without raising additional funding. And eventually, the situation reached a breaking point. Spirit Airlines filed for Chapter 11 bankruptcy protection, marking another dramatic chapter in the company's turbulent history. Bankruptcy doesn't necessarily mean the airline will disappear immediately. Instead, Chapter 11 allows companies to restructure their debts while continuing to operate. But it does signal how serious the financial situation has become. Winners and losers. Spirit's crisis has created ripple effects across the airline industry. Some companies may actually benefit from the situation. For example, Frontier Airlines, which almost merged with Spirit, could potentially gain access to Spirit's customers or even purchase some of its assets if bankruptcy restructuring occurs. Meanwhile, large airlines like American, Delta, and United face less pressure to match extremely low fares on certain routes. But there are also clear losers. Spirit employees are facing layoffs and uncertainty as the airline reduces its fleet and operations. And passengers who relied on Spirit's ultra-cheap tickets may find fewer affordable travel options in the future. When Spirit entered a market, ticket prices across airlines often dropped significantly. Without that competitive pressure, air travel could become more expensive, especially for budget-conscious travelers. The bigger lesson. The rise and fall of Spirit Airlines offers some powerful lessons about business strategy. First, competing only on price can be risky. If competitors can easily copy your pricing model, your advantage may disappear. Second, customer experience still matters, even in the budget market. If passengers repeatedly have negative experiences, they may eventually choose alternatives. Third, operational resilience is crucial. A business model that works perfectly during good times may struggle during unexpected disruptions. Finally, timing can make or break a company. Spirit expanded aggressively just before a global pandemic reshaped the travel industry. Despite its struggles today, Spirit Airlines left a lasting mark on aviation. It forced the entire industry to rethink pricing, fees, and budget travel. Those bright yellow planes may not dominate the skies the way they once did, but their influence on how people fly will remain for years to come.